I'm going to review my entire eToro stock portfolio in this video. We've outperformed by over 2% year to date, which is pretty good performance. Since I opened this account, you can see we're still outperforming from August 2024. We've been ahead of the S&P, the entire time. If you look at the total performance, you can see there's a bit of a wider margin where we've outperformed by, 7%. So if we go from the bottom of the portfolio, you can see here our worst performing position, Adobe, we're down 28%. I've held Adobe pretty much since I opened this account. Adobe, if you don't know, is the global leader in creative software. Their product suite provides creative professionals with all the tools that they need. Some of their products include Photoshop, Illustrator, Premiere Pro. They also provide products for documents such as Adobe Acrobat, which supports PDF workflows and e-signatures. Some investors are speculating that Adobe's business model is under threat by developments in artificial intelligence capability. I sort of maintain the view that Adobe will benefit from integrating AI into their existing products. And that's pretty much how I see Adobe. That's why, despite being down 30% on the position, I'm still going to hold, because I actually think the valuation is pretty compelling. If we look at the valuation on Qualtrim, which is it's the main software I use for analyzing stocks, you can see the free cash flow yield, which is a good measure of the sort of valuation of the business. It divides the free cash flow per share by the price, as you can see here. And it's a 6% yield, which is, if you take into account stock-based compensation, is 5%. So it's a more realistic number. 5% free cash flow yield for a company like Adobe, if you look at the revenue growth of around 10% still, obviously it's decelerated slightly from the 18% over the last 10 years average, but that's still quite fast revenue growth for the valuation. And I mean, you can see in the free cash flow yield over time, if we go over the last 10 years, which we're on, the higher the free cash flow yield, the cheaper the valuation, and the lower the free cash flow yield, the more expensive a stock is. And so if you look at it right now, it's one amongst the highest free cash flow yields that Adobe's stock has had. And importantly, if you actually look at the free cash flow per share, especially if you adjust for stock-based compensation as well, it's growing faster than the revenue. And the reason for this is that Adobe are actively reducing their share count by buying back shares. I mean, if you look from, I think maybe they must have done an acquisition around 2006-07, where it spiked here. But then since then, they've just been buying back millions of shares every year. And so the next company that we'll be looking at in the second smallest position in the portfolio is Salesforce, which are still led by their founder, Mark Benioff. They provide products that help businesses manage their customer relationships, and they have 5 different revenue segments, which we can actually see broke down here. And they're all basically of equal weight. And the company provides solutions for lead generation, customer service, digital marketing, and much more. The industry has many competitors, but Salesforce still maintains a market share larger than its 4 closest competitors combined. So it's a very dominant business. If we take a look back at the portfolio again, Salesforce is another position where, like Adobe, we're in the red at the moment. We were actually up about 30 or 40% on Salesforce, but the stock has just plummeted. If we look at Salesforce on Qualtrim, you can see the price is just, 25% year to date. It's probably, with Adobe, the worst performer in the portfolio, because like I said, after a few months of, building the portfolio, opening the account, we were up about 30-40%. I think we were buying in September time, and then by sort of, December, we were up massive on Salesforce. But unfortunately, since then, the prices fell. Some of the reasons for the fall in price could be to do with recent acquisitions that Salesforce has made. If you look at the revenue, it's slowed slightly. I mean, slightly is probably an understatement. Over the last 10 years, the annualized revenue growth was around 20%. And then you see over the last sort of 5 years, 16%, 2 years, 10%, 1 year, 8%. So investors do fear that revenue is slowing. And I think maybe that's why Salesforce, part of the reason they've gone and made some acquisitions is because they feel they need that to increase and re-accelerate revenue growth. I will be watching closely in the next few quarters how Salesforce kind of try and boost that revenue, because if revenue growth stays at around 7 or 8% for the foreseeable future, I might have to swap Salesforce out for a company on my watch list that are growing a bit faster, because 8% revenue growth, despite free cash flow per share growing faster, if we look at free cash flow per share, it's actually growing really fast because margins have been boosted. And I think they have been doing a few buybacks. But with the acquisitions they've been making, I don't think those buybacks are going to continue like they were. So Salesforce might be probably the company I'm closest to removing from the portfolio and swapping with maybe another company. Speaking of other companies, the next one in our portfolio is Hermès International, basically the pinnacle of luxury and status. Hermes, they're famous for the Birkin bag, the world's most expensive handbag, which ranges in price anywhere from $10,000 to $2 million. Some of these handbags have auctioned for. Their business model is comparable to Ferrari's exclusivity focused approach of limited supply combined with huge demand from high net worth individuals. To give you an idea of the scale of Hermès' success, LVMH, the largest luxury goods company in the world, is valued at a 244 billion euro market cap, whilst owning 75 different brands. Whereas Hermès, a single brand, their company is valued at 220 billion euros, so not far off LVMH. Next up in the portfolio, we've got Intuit. They're known for their accounting software, QuickBooks. Intuit also provides other types of financial software targeted mainly at small and medium-sized businesses, such as their DIY tax filing service, TurboTax, marketing automation and email campaigns through MailChimp, and tax software for accountants via ProTax. This financial software ecosystem allows Intuit to cross-sell their products very effectively. Next up, we've got Mastercard and Visa. Their business models are so similar that I might as well combine them whilst we're talking about it here. So Mastercard and Visa operate payment networks, acting as basically the backbone of the digital economy. Their networks act as digital railroads, connecting banks, merchants, and consumers, and processing trillions of dollars in transactions every year. They charge small fees, profiting from every transaction on their network. Visa is the largest payment network globally, with MasterCard in second place, but growing slightly faster. Their continued growth is spearheaded by the global transition from cash payments to digital payments. Visa and MasterCard are probably the two most predictable businesses in the portfolio. Like I said, you'd expect the revenue of these two to just keep climbing around 10% a year as the trend of cash transferring over to digital payments continues. I mean, the fact that Visa has over 5 billion or almost 5 billion cards outstanding is crazy. I mean, MasterCard has, I think, 3 or 4 billion total cards as well, which basically means everyone on the planet has one of these cards. Obviously, it doesn't work out to every single individual because, children can't have credit cards, and, parts of the third world, they don't have digital payments yet. However, people in the West, they might have 4, 5, 6 credit cards, or if you add debit cards in there as well, that's how you get to around 8 or 9 billion credit and debit cards outstanding. Next up, we've got S&P Global. They're one of the two main credit rating agencies alongside Moody's. But S&P Global is among the world's most important financial institutions. Both Moody's and S&P Global rate corporate and government bonds, and their ratings impact how much these companies or governments pay to borrow money, basically what their interest rate will be. and recent estimates of the size of the global bond market is around $140 trillion. However, S&P Global also provides data analytics and research tools with their market intelligence segment, maintains and licenses benchmark indices such as the famous S&P 500 and Dow Jones Industrial Average, delivers pricing news and analytics for commodities with their commodity insight segment, and finally offers data and analytics for the automotive and mobility sectors through their global mobility segment. Although the company recently announced it plans to spin off this segment into a separate publicly listed company. So as you can see, S&P Global as well is a larger sized position, 6.25%. Um, I like to sort of do my position sizing in sort of like 1.25% increments. Um, I don't really like having positions smaller than 5%. That's why all of the smallest positions are basically 5% positions. Um, so yeah, on to the next company after S&P Global. We have Netflix, which is actually the most recent addition to the portfolio. So it is still in the red slightly, down about 1%. Netflix, as I'm sure many of you know, is an online video streaming service. They have over 300 million subscribers, and I would say they're well ahead of traditional streaming services such as Amazon Prime Video and Disney Plus. And as a result, I believe their main competition really is Google owned YouTube. Now, I mean, we're starting to get into the sort of big guns of the portfolio. With Netflix, I invested about 7.5% of the total capital in the portfolio. And then our next company, we actually invested less. However, the huge gains from Uber, which is the next company, have basically pushed it up above Netflix in the portfolio in terms of actual current value. Uber is probably one of my favorite companies that I own in the portfolio. Maybe partially because it's one of the best performing, but you can still get Uber at a pretty decent valuation, around 4% free cash flow yield, which for a company with two, people think Uber just do taxi services, but actually Uber Eats, their food delivery platform, is around half of their total gross bookings. So it's actually a very diversified company. So yeah, Uber is our best performing stock year to date. They provide taxi and food delivery services on their app. The two segments, like we just discussed, they make up roughly half of total gross bookings, which is interesting because Uber is known for being a taxi service, but not so much for food delivery. They've recently introduced their subscription service, Uber One, which, as we can see on the chart here, has 36 million members already. They're doing a lot of promotions with this, so like a lot of those members will be like free trials. However, I do think the numbers are going in the right direction, and the benefits that they do provide, as someone who uses Uber quite frequently, I think they do make economic sense for their more than, I think they have 180 million monthly active users. So I mean, if they could even get to 50% of their monthly active users being Uber One members, that'd be 90 million paid members, which would be crazy. The amount of profit produced from those subscriptions, it will push up their margins for sure. But yeah, I just think Uber are way ahead of the competition. The only risk I see really is the impact of autonomous vehicles and how they're going to replace human drivers, which could cause a disruption to the business. But from what I've seen, Uber is managing the change well, partnering with multiple different firms to provide autonomous rides to their users. So I think autonomous vehicles isn't that big of a threat, really. Next up, we have the best performing stock in the portfolio, Booking Holdings. Booking is an online travel agency with a majority of the European market share. And not only do they own Booking.com, where you can book hotels, flights, and car rentals, basically anything in terms of holiday needs are met by Booking. They also own restaurant reservation service OpenTable and price comparison website Kayak. As you can see from the margins, Booking are a very profitable company. 20% profit margins and 33% operating margins. That's significant. And they use a lot of their profit, most of their profit, for share buybacks, which you can see from the shares outstanding over the last sort of 15 years, 12 to 15 years. They've bought back millions of shares. And that's why the stock price is what it is, over $5,000 a share, because they didn't really have many shares outstanding to begin with. And then they've gone and bought back probably, I think, a quarter of the company's shares outstanding over the last sort of 15 years. It's unusual. These kind of stocks, I think they're known as cannibal stocks, where like the company basically eats its own share count, which provides huge value for shareholders. So the next company in the portfolio is Meta Platforms. Initially investing around 8.75%, and now because of the 30% gains, which have been pretty good from Meta over the last few years, even the total current value is almost 10% of the portfolio. Looking at Meta on Qualtrim, some of the things to know about Meta Platforms is that it's owned and operated by their founder, Mark Zuckerberg. They own social media giants Facebook and Instagram alongside messaging app WhatsApp. Meta's family of apps are used by over 3.48 billion users on a daily basis, which is just insane. I mean, that's like half of the world's population use an app from Meta every day. So it's entrenched in people's lives. The company is benefiting from improvements in artificial intelligence, which can help them improve their algorithms and add new features to the apps, which keep users engaged for longer and allows them to sell more ads, because that's the business that Meta Platforms are in. They sell ads, and if you look at the profit margins, I mean, that is crazy profit margins. We was talking about Booking with 20% being quite significant, but 40% profit margins is probably amongst the best in the world of any business. Next up, we have Amazon. I invested an initial 10% in Amazon. After a gain of 20%, it now makes up just over 10% of the portfolio. Amazon are widely known for their market-leading presence in online shopping. And the thing is, Amazon is more than just an e-commerce company. They also lead in the fast-growing trillion-dollar cloud computing market with their Amazon Web Services. You see in the dark blue, that's AWS, with revenue of nearly $120 billion. They also compete for viewers with their Prime Video service against the likes of Netflix and YouTube. That revenue is probably included in the subscription services. Next up, we have Alphabet, better known as Google. Also 10% of the portfolio alongside Amazon. Recently, they've had a nice run up in price, and now reaching almost 11% of the total value of the portfolio. The majority of Alphabet's business is centered around their Google search engine. As you can see from the orange bar, that makes up $210 billion of annual revenue. However, they also own video sharing platform YouTube. They operate their Google Cloud service, which competes with Amazon's AWS, and autonomous taxi service Waymo. There's been heavy speculation around Google's future as the emergence of large language models like ChatGPT are seen as a threat to its core search business. However, as far as I can see, the new technology hasn't really negatively affected Google. Like if we filter out all of the other business segments here, you can see the growth hasn't really slowed down in Google search, which would be your expectation if you thought AI and ChatGPT are going to disrupt Google's search engine. You'd expect the revenue to slow, but it's showing no signs of that. So it seems really that Google's own AI, Gemini. They're integrating it into search, and it seems to be paying off for Google. And finally, last but not least, we have Microsoft. We invested around 10% of the portfolio in Microsoft back in March. The gains since then have been pretty sweet, 30%, making it 11% of the total current value of the portfolio. So they're currently the second largest company in the world by market cap. And Microsoft competes in many different sectors, including cloud computing. As you can see, the light orange bar here is almost $110 billion of annual revenue from their Microsoft Azure cloud services. They also provide office software like Excel and Microsoft Word. I'm sure a lot of you would have used that for work or for, I don't know, like university, schoolwork kind of stuff. They also own Xbox, Activision Blizzard in their sort of gaming segment. Social media, they own LinkedIn, which is probably the most sort of like popular professional social media site. I'm always open to feedback, so let me know in the comments what you thought about the portfolio and where you think I could improve it.